If you just take a quick glance at the stock market this year, you might think, well, it's kind of boring. Looks like a perfectly calm lake, right? But believe me, beneath that still surface, there are these powerful, almost violent currents churning everything up. Today, we're going to dive in and figure out what's really going on in those depths. So get this, year to date, the S&P 500 index is, well, it's essentially flat. We're talking down just 0.03%. That's not even a blip. But hold on, that tiny little number is hiding an absolutely wild story. Just look at the individual sectors. Energy is on a tear, up nearly 20%. And at the exact same time, you've got financials and tech down 5%. These are not small moves, folks. This is a market getting ripped in completely opposite directions. So, what in the world is going on here? That's the big mystery we're tackling. If the overall index is just treading water, what's causing this incredible chaos right underneath? It's a puzzle for sure, and we are going to piece it together, clue by clue. All right, clue number one. This gets to the what of this whole situation. We've found ourselves in what a lot of analysts are calling a stock picker's market, and it's all being driven by a technical concept that has gone completely, and I mean completely off the charts. The keyword here is dispersion, and honestly, the idea is pretty simple when you break it down. Dispersion is basically just the gap between how much an average individual stock is moving versus how much the entire index is moving. So when dispersion is high, it means individual companies are on an absolute roller coaster, even if the market average looks totally dead calm. And folks, this is where it gets crazy. This chart of the last 30 years shows just how not normal things are. Look all the way to the right. We just hit a level that is a 3.5 standard deviation event. Now, for you stats nerds, you know that's a 99th percentile outlier. For the rest of us, it means this is incredibly rare. It's a signal of truly extreme conditions, the kind you might see once in a generation, where individual stocks are moving with historic volatility. Okay, so we've got the what, this extreme dispersion. But that just begs the next question, right? Who is driving all this? Our second clue points to a totally unprecedented wave of individual, or as they're called, retail investors. This chart here shows the average daily cash flowing into the market from regular folks indexed all the way back to 2020. See that blue bar on the right for 2026? It's not just a little bit high, it is nearly 25% above the previous crazy peak in 2021, and it's double the average of the last 5 years. This is nothing short of a historic flood of cash. And here's the kicker. This isn't just some flash in the pan, a one-time spike. The monthly data shows this buying has been sustained. It even set a new all-time monthly record. This is a persistent, powerful force in the market. A new army has arrived on the scene, and it looks like it's here to stay. So you've got this army with all this cash. What's their battle plan? Well, it's super clear and super aggressive. Buy the dip. Let's see this strategy in the wild, okay? First, take a look at the software industry. As you can see from this chart, it has been hit hard. It's fallen to one-year lows compared to the rest of the market. This right here, this is the dip that these investors are eyeing. And boom, here's the reaction. While that black line shows software prices taking a nosedive, just look at those blue and red bars at the bottom. That's the cash pouring in from retail investors. As prices fall, they don't get scared and run away, they charge right in. The source material for this actually says this dip buying has reached historically extreme levels. They are aggressively buying into the weakness, and it's adding rocket fuel to all this volatility. So let's recap. We've got insane dispersion. We have a retail army buying every dip in sight. Our final clue explains where all this money is actually going. Because it's not just about buying what's down. It's about a massive, high-speed scramble between totally different parts of the economy. This quote from the source material really just nails it. Capital is not exiting risk. It is being aggressively reallocated. People are just selling everything and hiding in cash. No way. They are selling one thing to turn around and aggressively buy something else. It's a massive rotation. And this whole shuffle is happening at lightning speed and with a ton of conviction. It really feels like the market's new mantra is sell first, ask questions later. And that kind of mindset is causing entire sectors to get completely repriced almost overnight. Wow. I mean, this slide right here tells you everything you need to know. It's the whole story in one picture. On the left, you see the software sector we've been talking about hitting those one-year lows. But on the right, at the very same time, the industrial sector is hitting one-year highs. It's literally a tale of two completely different markets existing at the exact same time. So what's really happening here? This isn't random. We are seeing a massive fundamental shift in what the market actually values. The old guard, the leadership of the past decade, asset-light tech companies, all about software, that's what's being sold off. And that capital is being aggressively reallocated to what look like the emerging leaders, companies with real physical assets, cyclicals, and other value-oriented parts of the economy. All right, time to connect the dots. We've got extreme dispersion, a retail army buying the dips, and this great sector scramble. So, what does it all mean? What's the big reveal? It's that all this crazy volatility, it isn't a temporary bug. It's the market's new core feature. So all of this creates a market with what the pros call fatter tails. It sounds technical, I know, but it's a really powerful idea. It just means that the probability of extreme events happening, both the incredibly good and the incredibly bad, is much, much higher than normal. That safe, boring middle ground we used to know, it's shrinking. So what does that mean for you? Well, on the upside, it's pretty big. Historically, after periods of stress, just like this one, the potential for big gains, we're talking the 90th percentile outcome, jumps to over 10% in the next 30 days. But, and you knew there was a but, right? This is a two-sided coin. The tails are fat in both directions. So on the downside, the risk of big losses, the 10th percentile outcome, gets worse, dropping to over 6%. The potential for big wins and big losses both go up. So let's just boil it all down. What does this new market look like? Simple. The chance of big wins has gone up. The chance of big losses has also gone up. That flat average return we started with is becoming pretty meaningless. Extreme moves in either direction are just more common now. This is the new normal. When you really think about it, this final quote just says it all. This is less an index-driven market and more a reallocation-driven one. The main story isn't about the whole market going up or down anymore. The real action, the real story, is this fierce, aggressive reshuffling of capital happening just beneath that calm surface. And all of this leaves us with the one question that really matters now. In a market of extremes, where the old leaders are falling and new ones are trying to rise, where the range of what could happen is wider than ever, where does true, durable value actually lie? That's the billion-dollar question everyone is trying to answer.